Now going to have a special FMCG discussion, and we will come to you in a bit. We've got another expert joining us, Abneesh, Executive Vice President for Institutional Equities at Edelweiss, and of course we know him as the best FMCG expert. Morning, Abneesh. We have the whole sector to discuss with you in our quarter tak segment. But first, I wanted your views on Nestle. I mean, 62 times is where the stock is trading forward. Now, in spite of inline numbers, you like it? Your thoughts on the results?
Good morning. So absolutely, Nestle is among our top picks, and last quarter there was slight disappointment in terms of salary cost zooming. We had that time itself said salary cost in FMCG company is not a key metric to monitor, and it was a one-off cost. It was related to COVID. This time Nestle has managed staff cost really well, only 2.6% up, but the headline numbers are really good. So if you see on a 2-year basis also, Nestle's domestic business has seen a 22% sales growth. And out of last 14 quarters, 13 quarters, we have seen double-digit sales growth in the domestic part of the business. Good part is exports, which has disappointed last 2 quarters, that also is now entering soft base. And in-home consumption will see a significant pickup. See, important to note that in June quarter, the two food companies last year had a very different performance. Britannia saw 23-24% volume growth, while Nestle saw hardly low single-digit growth. That was because Britannia's factories were functioning. They are present across states. Nestle's factories were closed in multiple locations because of the COVID restrictions. So Nestle enters soft base there also. Plus in-home consumption we are seeing across categories. Now coming to margins, because everyone is worried on the inflationary condition. So this quarter, if you see, Nestle's gross margin also expanded and EBITDA margins also expanded. EBITDA margin at a multi-year high level. Going forward, because of monsoons being good, the key raw materials for Nestle are looking again reasonable and reasonably benign, I'll say, because wheat, sugar and milk prices, because of the good monsoon, I don't see any significant reason to worry. Yes, the packaging cost, which is hardly 15-20% of the total cost, that is inflationary, but we have seen crude at $120 also. So I will say Nestle has extremely high pricing power. The new products like breakfast cereals, breakfast options, and multiple new innovations they have done, most of those are successful. E-commerce on a very high basis, again grown 65%. So I will say in FMCG companies, multiple, I think that's a very wrong data point to start with. You have to see where there is tailwind in terms of demand side, where there is pricing power, where there is raw material comfort also. I think Nestle ticks all those parameters. So I will say Nestle will give 20% return in the next 1 year. And
okay, got that. Yeah, Abneesh. Yeah, got that. Actually, all analysts are thinking like you and not getting worried at all by the 62 times. But now we are broadening this discussion, as we told you, our favorite quarter tak segment, in which we're going to discuss FMCG expected numbers. Mangala Malu is here.
Well, for the fourth quarter in the FMCG sector, it's going to be all about the base, because at the same time last year towards the end we had the lockdown that was announced, and that made all the companies look like a weak set in the last year. So on that, the results will look stellar. Not just that, quarter on quarter there will be improvement, because one, urban India started to improve, and there was rural recovery which was sustained. So all of that would result in a good quarter for all the FMCG companies. What will lead the growth this time around? Well, discretionary and non-essential products, because Jan-Feb, the fear of COVID had ebbed, and as a result of which we did see a lot of these products see some improvement as well. The only fly in the ointment will be the raw materials, because margins may compress both quarter on quarter because of sharp raw material and fuel inflation. But above everything else, the management commentary for the quarter that we're currently in will be key, because that will talk about the impact of the second wave of COVID. To tell you what is ahead, we need to know what has been reported as well. Titan has said they have 60% revenue growth in the fourth quarter on a low base. Godrej Consumer has said their India business has seen 30s, the growth in 30s, and Marico as well saw strong double-digit growth in India. We spoke about Nestle. The domestic growth for Nestle as well this time around was in double digits. So all of that means that this quarter we are expecting very strong revenue growth for all of the companies, and we have to keep in mind the base as well. Asian Paints 35% plus growth is expected. Remember, the base is just around 2.5%. Britannia on 0%, 8 to 10%. For HUL on a decline of 7%, we're expecting a 15 to 18% sort of volume growth. And for all the other companies as well, that should come up for you. ITC on an 11% decline, we're expecting a 9% growth. For Dabur and Imami, 15-20% decline is what we have in the base, and 35 to 40% is what we're expecting. FMCG, the sector's never been cheap, and this time around as well, trading anywhere between 60 to 64 times for the frontline FMCG stocks. And for the lower stocks as well, we have ITC, barring ITC, which trades sub 20 times, Imami, Dabur, both of them between 30-47 times. So growth in this quarter will look good, but most important will be management commentary on the quarter that we're currently in.
Okay, thanks a lot, Mangalam. That was very helpful. Abneesh, coming back to you, just simplify it for us. If you had to give us one or two stocks where there is both earnings upside and some valuation headroom, what would top your list now?
Yeah, absolutely. It's a good question. So we are definitely entering a soft base for some of the laggard segments as we go ahead. Now I'm not talking about the March quarter. I'm talking about now the next 6 months outlook. So I would say Nestle and Hindustan Unilever, there is a comfort because these two stocks have massively underperformed players like Dabur and Asian Paints, etc., within that same space, broad space. And second is they are going to see huge benefit in-home consumption. For a player like Hindustan Unilever, there can be a question, what happens to their laggard segments like discretionary, skincare, etc. The good part is now that's already factored in the base. Plus, HUL is very well diversified. So on the commodity basket also, HUL will see issues in two segments, tea and soaps. But in most of the other segments, they have reasonable inflation under control. But more importantly, the pricing power which is coming back for the sector after 2 years, that will help in terms of the absorption at the EBITDA level. So I don't see HUL's EBITDA margins declining in this entire year. In fact, next 2 quarters, we'll see the base being very soft. So we should see very strong set of numbers from HUL, Nestle going ahead also. After this, the pecking order becomes a bit more expensive, not too much of comfort on valuation. Those will be essentially Dabur and Asian Paints. Britannia, some base effect will be there next quarter. So I will say Nestle, HUL, top 2 picks, and after that, Dabur and Asian Paints.
Okay, so that will be your pecking order. Abneesh, thank you very much for joining in. You have a good day, and we look forward to our next chat. Well, that's on FMCG. Gurmeet, I'm going to come back to you, slightly related play if you're talking rural, Hero Moto. And